Let's start with Sunday's event where African economies and their finance ministers, to be specific, told their Western world counterparts to work harder, faster and smarter to get their economies back on track and growing once again, lest they prolong a slump that may in turn affect growth in the developing world. Over the weekend, these individuals were meeting at the spring meetings of the IMF and the World Bank, and the Nigerian Finance Minister Ngozi Okonjo-Iweala said that the continent would become quite vulnerable if there was a continued slow growth in the Eurozone, which provides an enormous market for many African countries. She said that partners in other parts of the world need to work a lot harder and faster. Now, despite a global economic slowdown in 2012, most African economies grew at close to 6%, buoyed by strong internal demand and higher commodity prices as well. Now let's expand this conversation further. CCTV's Miriam Bemard is live in London, also joined by Suzanne Pratt. She's live in New York for us tonight. Suzanne, let's start with you. What are the reactions from Western finance ministers to the message they were given by their African counterparts?
Well, clearly everybody would like to see the U.S. grow at a much faster clip. We're probably going to learn on Friday that we had GDP in the first quarter of around 2.8%. That's not what the U.S. wants to see, and that's not what the world wants to see. But you have to understand we are in the midst of a massive global economic debate. Growth versus deficit reduction. And it's unclear which is going to win out here in the U.S. There's a lot of political forces battling each other out. So we're going to have a little bit of both. Efforts to inspire growth and efforts to cut the deficit. So not all is hopeless, though, because don't forget the U.S. private sector is probably also going to play a role in this discussion. And U.S. companies from Walmart to GE want a piece of the African pie. And so if the U.S. government doesn't do enough to inspire growth or encourage growth here, look for the private sector to step in. If the U.S. private sector doesn't step in, China is most likely going to pick up the slack.
Indeed. Miriam, the distraction, if I may call it that, over Cyprus did derail a lot of coverage from the key issues of economic reform in Europe. After the bail-in of Cyprus, what's happening to efforts to put in a single bank supervision mechanism in Europe?
Well, you know, Ramos, certainly Cyprus changed the game. It showed how important it is to have a standard system in place, monitoring European banks, lining up preventative measures to reduce bank failure. But it also shows that some sort of deposit guarantee or insurance needs to be in place to protect people, and very much reminded everyone that the banking union supervisory hasn't been ironed out. You know, at this point, the European Commission and the ECB need to find a balance between supervising institutions without causing political rifts. But as Suzanne said, it's that constant battle between growth versus spending cuts and austerity, but also not being too lenient to the detriment of taxpayers, of course, in other countries that also suffer when a big bank fails.
Indeed. Suzanne, let's come back to you and talk about inflation briefly here for a moment. It hasn't risen as high as some would have expected given successive rounds of quantitative easing, especially in the United States. Is Ben Bernanke and the Fed in general confident that they can contain any spillover effects from subsequent rounds of QE?
I think that you have to remember that Ben Bernanke and his friends on the Fed are on very, very close bubble watch, because that's really what we're talking about. Are we going to see any asset bubbles in the United States? And so far, so good. There really hasn't been anything much to speak of. Even the commodity price run-up that we saw looks like it's run out of steam. And I have been doing stories for several months and probably even a few years about a bubble in the bond market. That hasn't come about. Now, one could argue that the stock market is seeing a bit of a bubble, but I think that most people would probably agree that we're not even there yet. You've got to remember that the PE for the S&P 500 right now is trading at about 18, and at the top of the big bubble for the stock market in 2000, it was about 30. So I don't think that there is any real risk, imminent risk, of there being any bubbles in this country at this particular time.
Final question to you, Miriam. Europe's future growth is essentially based on the premise that it will have a strong single banking mechanism and a fairly strong economic and monetary union as well. What's the ripple effect if we have a delay here on sub-Saharan economies?
Well, you know, it's a balancing act, Rama, especially given the risk-reward balance that Africa has faced with investors in the past. You know, many experts that we speak with say Africa needs to reduce its exposure to highly indebted countries and shift its focus on attracting investors looking to essentially fuel their growth. Governments should try and move away from traditional resource-based money and more into infrastructure and retail investment and projects. Now, despite the growth that we have seen in sub-Saharan Africa, Europe's ongoing debt crisis means poor business confidence and weaker trade for the bloc, which directly affects Africa's prospects. That, along with an intertwined global banking sector, means not only is Africa's economy directly exposed, but so is its banking sector. Now, South Africa, for example, is one the biggest borrower from Europe, if you will, started having problems with outflow of investment capitals back in 2011, putting pressure on its economy. And that's what we want to see avoided moving forward. At the same time, the commodity sector is no longer that safe haven as it was back in 2010 when prices rebounded and Africa's slowdown was short-lived.
Indeed. We'll have to keep a very close eye on FDI inflows. We'll have to be there for the time being. Suzanne Pratt in New York and Miriam Bemard in London. Thank you very much for your time this evening.